Hello everyone, Rahul Shayar, trying to make investing accessible and profitable for the average investor. Let me start with something you might have seen over the last few days. If you spend time on LinkedIn or Twitter, which is now called X, you've likely come across a chart. The chart asks a quiet but provocative question, and the question is this: what if you had invested rupees 1 lakh every single year for 35 years? But here is the catch: you only invested at the highest Sensex level of that year, meaning every single year you picked the worst possible day, the day when prices peaked, the day when everything felt expensive. What do you think happens? Now, most people would guess disaster. They would guess that you end up with very little money. But that is not what the chart shows. The answer is rupees 3 crores at a CAGR of 10.5%. Now the same chart flips the question: what if you had invested the same rupees 1 lakh every year, but this time only at the lowest Sensex level of that year, the best possible day, the day when fear was highest and prices were cheapest? Well, the answer jumps to rupees 5 crores at a CAGR of 12.6%. Same discipline, same amount of money, same 35 years, and yet a difference of rupees 2 crores. Purely because of luck, because of which day of the year you happen to invest, not because of skill, not because of research, just luck. Now let us pause here for a moment, because this is where most people stop reading. They look at this chart, they feel a little reassured that even bad timing works out okay, and they move on. But this is also where the real story begins. Because what if you aim higher? What if you refuse to settle for luck? Now let us run the numbers one more time. Same rupees 1 lakh per year, same 35 years, but this time instead of the Sensex 10 to 12%, what if you target just 5% more per year? That takes you to a 18% CAGR. Now watch what happens. The final corpus is not rupees 3 crores, it is not 5 crores, it is 18 crores. Yes, 18 crores. That is not a typo. Let me say it again: 18 crore rupees. Think about what that means. Over 35 years, you would have invested a total of rupees 35 lakh. Just 35 lakh. And compounding at 18% turns that into a life-changing number. A number that buys freedom. A number that changes your family's future. So the natural question follows, and it comes loud and clear: should you even try for 18%? Is that realistic? And more importantly, is there a repeatable blueprint to get there? Or is this just a mathematical fantasy? Well, most people stop at the first question. They say 18% is unrealistic. They call it luck. They call it a bubble. They call it hindsight bias. They say, oh, that only happens in textbooks. But a small group of investors would disagree. And not just any investors, some of the greatest investors who've ever lived. And they left their answer in a speech from 1984. Let me take you back to that year. In 1984, Columbia Business School hosted a conference. The occasion was the 50th anniversary of Benjamin Graham's legendary book, Security Analysis. Now, this book is often called the Bible of value investing. And at that conference, a then little known but already remarkably successful investor named Warren Buffett gave a speech. The title of the speech was The Super Investors of Graham and Dodds-Weir. Now here is what Buffett did in that speech. He presented data on 9 different investors. These 9 people were not working together. They had different portfolios. They operated in different time periods. They bought different stocks. They had different personalities. Some were aggressive. Some were very patient. Some worked alone. Some had partners. But they shared 2 things in common. First, they had all beaten the market. Not for 1 year, not for 5 years, but for decades. Year after year, through bull markets and bear markets, they consistently outperformed. And second, they all followed the same blueprint, and that blueprint comes from the same guru or came from the same guru, Ben Graham. Buffett's point was simple and powerful. He said, this is not luck. You cannot have 9 different people in different cities buying different stocks and all of them getting lucky for 20 or 30 years straight. That is statistically impossible. What you're seeing, Buffett argued, is a teachable, repeatable method, a blueprint, and that blueprint is available to anyone who is willing to learn it. So let us slow down and actually understand that blueprint, because it's not complicated, but it is deep, and the depth is what makes it powerful. Graham gave us 4 core principles. Let me walk you through each one carefully. The first principle is about a character Graham invented. He called him Mr. Market. Some days, Mr. Market is euphoric. He has had great news. He sees nothing but blue sky ahead. On those days, he offers you a very high price. He says, I'll pay you a fortune for your share of the business. Other days, Mr. Market is depressed. He has read something scary. He thinks the world is ending. On those days, he offers you a very low price. He says, I will sell you my share for almost nothing. Now here is the key insight. Mr. Market does not care what you do. You are free to ignore him. You are free to take his offer. You are free to laugh at him and walk away. Your job is not to listen to him. Your job is not to be influenced by his emotions. Your job is to exploit him. When he is fearful and offering low prices, you buy. When he is greedy and offering high prices, you sell. Or even better, you simply hold and do nothing. Now, most people do the opposite. They get excited when Mr. Market is excited. They get scared when Mr. Market is scared. They buy high and sell low. Graham said this is the single biggest mistake investors make. The second principle is the most important one Graham ever taught. He called it the margin of safety. Here is what this means. You should never buy a stock at its fair value. You should never pay what something is worth. You should always demand a significant discount. Not a small discount, a meaningful one, a margin of safety. Why? Because you will be wrong sometimes. That is just reality. You will misread a balance sheet, you will underestimate a risk. A competitor will come out of nowhere. The economy will turn bad. Something will go wrong. The margin of safety is what protects you when that happens. It turns investing from a prediction game into a probability game. You do not need to be right all the time. You just need to buy at such a cheap price that even if you are partially wrong, you still do not lose money. The third principle is a simple distinction that most people never make. Price is what you pay, value is what you get. These are two completely different things. A stock can have a high price and low value. That happens during bubbles. A stock can have a low price and high value. That happens during crashes. Most people look at rising prices and think, this is a good investment. Graham looked at falling prices and thought, this is a good opportunity. He understood something profound. The stock market is the only market in the world where buyers run away when things go on sale. If your local electronics store puts television on a 50% discount, you would rush to buy. But when the stock market puts quality companies on a 50% discount, most people rush to sell. Graham said you should do the opposite. The fourth and final principle is about temperament, and this is the one that surprises most people. Every person in Buffett's 1984 speech was intelligent. They were all smart. Some were brilliant. But what set them apart was not their IQ. It was their temperament, their ability to sit still, their ability to do nothing for months or even years, their ability to wait for the right opportunity and then act only when the margin of safety was absurdly large. As Buffett later said, and I'm paraphrasing here, investing is not a game where the person with the 160 IQ beats the person with the 130 IQ. Once you have ordinary intelligence, what you need is temperament. You need to be calm when others are panicking. You need to be skeptical when others are greedy. You need patience, and patience is rare. So those are the four principles: Mr. Market, margin of safety, price versus value, temperament over intelligence. Now let us ask the question that matters most for Indian investors. Does this blueprint work in India? Because the United States in the 1950s, 60s and 70s was very different from India in 2026. Different regulations, different companies, different currency, different culture. But here is the truth: the Graham blueprint is not about geography, it's about human nature. Fear and greed are not American, they are not Indian, they are human. Fear makes investors sell everything during a crash, exactly when prices are cheap. Remember March 2020 when the pandemic hit and the market fell sharply? Most people ran. They sold in panic. A very small number of people bought. Those who bought did very well. Greed makes investors chase IPOs. It makes them buy momentum stocks at peak valuations. It makes them follow WhatsApp tips. Remember 2021? The same stocks that everyone was chasing later fell 40 to 60%. This cycle repeats in every market, every decade, every crash, every rally. It never stops because human psychology does not change. Now we decided to test this. We ran a back test of the strict Graham framework in the Indian stock market between December 20 and December 25. And the results were frankly brilliant. Let me explain exactly what we did. We took the universe of the top 1,000 stocks in India by market cap. Then we applied two filters. First, a price to earnings ratio or PE of between 5 and 10. Second, a debt to equity ratio of between 0 and 1. Now let me slow down and explain why we chose these numbers, because this is important. A AAA corporate bond yield in India is at around 8% for many years now. This is what you could earn by lending money to a very safe company with almost no risk. Now, as a stock investor, you are taking more risk, so you should demand a higher return. Graham said you should demand a margin of safety, a meaningful one. We wanted at least a 25% margin of safety over the bond yield. That means you want an earnings yield of roughly 10.5 to 11%. Now, earnings yield is simply 1 divided by the PE ratio. So, an earnings yield of 10.5% gives you a PE of roughly 9.5. An earnings yield of 11% gives you a PE of roughly 9. So, we took a practical range of PE ratio of 5x to 10x to capture this margin of safety. Now, why not go below a PE ratio of 5? Why not buy stocks trading at 3 or 4 times earnings? Well, here is the answer. In the Indian market, a stock trading at a PE of 3 or 4 is rarely a hidden gem. It is almost always a value trap. What is a value trap? It's a stock that looks cheap but is actually cheap for a very good reason. Earnings are collapsing, there is massive pending litigation perhaps, the business model is structurally broken, the management is dishonest perhaps. Something is wrong. Graham himself warned about this. Buying something merely because it is cheap is not value investing. It is bargain hunting without a safety net. A low PE alone is not enough. You need quality. You need a clean balance sheet. And that is why we added the debt to equity filter of between 0 and 1. We want companies that are not drowning in debt. So with those filters in place, we built a portfolio of 20 stocks. Every year we rebalanced. If more than 20 stocks qualified, we shortlisted the ones with the lowest debt to equity ratio. The holding period was 1 year, and then we measured the results. The outcome? A CAGR of 34%. Let me say that again, 34% per year. Compare that to the BEC Sensex, which earned just 12% over the same 5-year period. That's a massive outperformance, almost 3 times the return of the index. Think about what this means. A disciplined, mechanical, emotionless screen. Buy cheap stocks, buy low debt stocks, hold for 1 year, repeat. That is it. No market timing, No fancy algorithms, no insider information, just the Graham blueprint applied to the Indian market, and it delivered 34% during a period that included rising interest rates, global volatility, and multiple geopolitical crises. Now let us go back to that viral Sensex chart from the beginning. The chart proves one thing very clearly. Timing the market involves luck. The difference between 3 crores and 5 crores over 35 years came down to which calendar day you invested. That is luck, pure and simple. You cannot control it, you cannot predict it. But the difference between rupees 5 crores and 18 crores, that is not luck, that's blueprint. That is the difference between accepting whatever the market gives you and actively seeking a margin of safety. That is the difference between following the crowd and following a proven process. The first gap, the 2 crore gap, is given to you by chance. The second gap, the 13 crore gap, is earned by discipline, by temperament, by a process that has worked for decades across continents, from New York to London to Mumbai. So here is my closing thought for you. You do not need to achieve 18% CAGR. Even 14 or 15% will make you wealthy over 35 years. The chart showed us that. But do not dismiss 18% as impossible. Do not tell yourself that it cannot be done, because it has been done before, not by lucky people, not by insiders with secret information, but by students of a simple, timeless blueprint. In India today, right now, you see the same patterns that Graham wrote about 80 years ago. PSU stocks that have been ignored for years and are suddenly being re-rated. Small cap companies trading below book value because of temporary bad news. Quality businesses hammered during foreign investor outflows, offering rare entry points. These are Graham-style opportunities hiding in plain sight. No, you will not find them in a WhatsApp tip. Yes, you will need to do your own homework, but the blueprint works because human psychology has not changed since 1984 and will not change anytime soon. The chart is viral, the speech is from 1984, the backtest data from India proves it works. The only question left is this: will you follow the crowd or will you follow the blueprint? Well, that's all from me today. I'll see you again in the next session. Goodbye and happy investing.